Hello everyone, welcome back to Comparative Investing Techniques CIT channel. This video we are using simple mathematics to share with investor why trading or speculation in the stock market always yield a poorer result as compared to investment. So with that, we shall bring investor attention to our spreadsheet calculation. So we use actually a very simple calculation to help investor to understand. What we do here is that when we actually trade on one stocks, say at the beginning the stock's price is actually at $1, we just buy one stocks as compared to a portfolio of just make up of two stocks. So when we invest in one stocks is $1. When we invest in a portfolio, we split up into two stocks, so each stocks at a initial price of 50 cents. Alright, so with that we do a 10 trade. So from this trading we have 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Alright, 10 trade. So out of 10 trade we have 5 trade that is positive. So every trade we make 10%. So all the green numbers represent positive, right? 5 trade. So each trade you make 10%, right? 1.1, 1.1 and 1.1. Alright, then we have another 5 trade and that actually we actually make losses, right? So you have 6, 7, 8, 9, 10. Alright, another 5 trade that we make losses. So this 5 trade, every trade we also lose 10%, right? 0.9, 0.9, 0.9 and so on and so forth, right? So this is basically to try to illustrate that if let's say we have a probability of 50% that 50% of the time that we are right and 50% of the time that we are wrong, and we actually trade on the stocks, and what is the outcome? So when you actually input all the numbers from the first trade all the way to the 10 trade, you realize that when you sum them out at the end of the day you actually lost 4.9%, even though you have 5 trade that make each trade that make 10% and 5 trade that each trade lost 10%, and thereafter you sum them out you actually lost 4.9%. So some in case some investor felt that, oh, because we have 5 trade at the beginning that is positive and 5 trade at behind is actually negative, so that's why you get this 4.9%. No, if you in whatever sequence you do, that means let's say you have the first trade is positive, second trade negative, third trade positive, in whatever sequence you do, the end result you will still have 4.9% loss. Alright, so next, when we actually look at the portfolio, so instead of we are doing individual stocks trading, right, we actually from a portfolio is split into two stocks. So when we buy, thereafter we hold on to it, and for one stocks we have 5 trade, right? Because over here is a total of 10 trade, right? So we have to be compare apple to apple. So here is each stocks only 5 trade, but each stocks at 50 cents as compared to this is $1 and 10 trade, right? So we have one stocks that actually have 5 trade, and each trade we have a 10% profit, exactly the same here, but just that we split into two. Alright, so you can have 10%, 10%, 10%, 10%. Alright, 5 trade. Then we have another stocks, and these stocks we have also 5 trade, and every trade we lose 10%, right? Same thing, just like what we have as per trading on a single stocks. Also 5 trade we actually lose 10%, exactly the same, right? 0.9, 0.9, 0.9, 0.9. Alright, so thereafter we add up these two stocks. Alright, because this is a single stocks, no need to add up, right? So for this is actually two stocks, so we add up. So when you add them out, and you get a total at the end of the 5 years or the 5 trade, you get $1.1. So we start at $1, right? So at the end of it we get $1.1. So we actually get 10.05%. So from these two examples, right, these two simple mathematics, you actually tell investor one very simple concept. When you actually buy one stocks, due to the compounding effect, my apology, I should actually explain this in the portfolio sense. When you actually create a portfolio, due to the compounding effect, you have one stocks that keep compounding and actually snowball the return, and at the end of it, from 50 cents it become 81 cents. right? So 50 cent to 81 cent, you actually increase by 31 cent. So the other extreme, you have a negative compounding effect, whereby it started at 50 cent and it end up 30 cent. So you actually lose 20 cents. So you realize that when the stocks actually go in a positive way for compounding effect, okay, it actually give a higher magnitude as compared to the negative compounding effect. So when you sum these two up together, all right, you actually still get a higher future value as compared to what you have at the present value. All right, so this is simple mathematics. But if on the other hand, if you focus on one stocks, that means you buy based on one stocks and you have your compounding effect plus positive and negative all in one stocks, then you realize that at the end of it, you actually end up with a loss, right? So that means in these two examples, you're actually having the same probability of getting right and wrong, right? Here also 50% right, 50% wrong. Here also 50% right, 50% wrong. But when you actually do a portfolio, automatically you outperform trading over the long run because of compounding effect, right? So now the next question is that how are we going to have stocks that actually give us more positive return as compared to stocks that have more negative return? So this comes to the point on setting your own margin of safety on the stocks that you buy, right? That means you want to buy at a deep discount below the intrinsic value. The deeper the discount, the higher the probability you will receive a positive return. And this is in investment, we always view risk and return relationship as low risk, high return. The lower the risk you buy, that means the cheaper the valuation you get in, the higher the probability you will receive a positive return. All right, and if you in contrast, the higher the risk you take, that means the lower the return you will receive, or sometimes maybe even negative return. All right, so as to setting how much margin of safety, if you sign up with us as a subscriber, then we will provide you with all the stocks that trade at a deep discount below the intrinsic value as investment opportunity. If you are not our subscriber, what you can do is that you can send in your valuation request to us to check on the intrinsic value of the stocks that you want to invest. Then thereafter you set your own margin of safety according to your own risk appetite. Alright, so with that we shall end our sharing on this simple mathematics to share with investor why over the long run a portfolio investment will outperform trading or speculation. Alright, so thank you for watching this video and goodbye.